Here is a research finding that should make every investor at least a little uncomfortable. Over multi-decade periods, the average investor consistently earns lower returns than the average mutual fund or ETF they invest in. Not because the funds perform badly, because of when investors move their money in and out. The fund earns, say, 9% per year over a decade. The average investor in that same fund earns 6% or 7% because they buy after a run-up when they're feeling confident, sell after a drop when they're feeling scared, and miss the rebounds that happen when they're sitting in cash, wondering when it's safe to get back in. The fund just sits there. The investor is the problem. Now here is the important part. This is not because those investors are unintelligent. They are not making random mistakes. They are making the exact same predictable mistakes, driven by the exact same cognitive biases that human brains have been making for as long as we have been making decisions under uncertainty. The biases are not bugs. They are features, hardwired responses to risk that kept our ancestors alive and that are genuinely terrible for long-term investing. This video covers 5 of them: what they are, what they actually look like in a Canadian investor's life, what they cost in real dollars, and the specific, named fix for each one. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. Here is the one. The bias that costs Canadian investors more money than any other. Loss aversion, documented in Kahneman and Tversky's prospect theory, is the finding that the psychological pain of losing a given amount of money is approximately twice as intense as the pleasure of gaining the same amount. Losing $1,000 genuinely, measurably feels about twice as bad as gaining $1,000 feels good. This asymmetry is not a personality flaw. It is a documented universal feature of human psychology. What it looks like in real investing life: you open your investment app on a down day. The portfolio is down $3,000. Your stomach drops. You think about selling, not because your thesis on the companies you own has changed, not because the business fundamentals have deteriorated, but because the discomfort of watching the number go down is genuinely painful in a way that has nothing to do with the actual long-term picture. Now imagine the portfolio was up $3,000. The feeling is real, but it does not produce action the same way. You do not rush to buy more because of a good day, the same way you want to sell on a bad one. The asymmetry in feeling produces an asymmetry in behavior, and the behavior is almost always the wrong one. What it costs. An investor who sells during a significant market downturn and waits for the market to feel safe before buying back in typically buys back in after a meaningful recovery, locking in the loss at the bottom and missing the rebound. Morningstar's Mind, the Gap studies have consistently found that this behavioral pattern produces return gaps of 1% to 2% annually across investor populations, which, compounded over 20 to 30 years on a meaningful portfolio, represents a genuinely enormous amount of money foregone. The 3-word fix: automatic monthly investing. The most effective known solution to loss aversion is not willpower. It is not telling yourself to be rational. It is removing the decision from the moment entirely. An automated monthly contribution that executes on payday, regardless of whether the market is up, down, or sideways, means the loss aversion response never gets triggered on the buying decision. Because there is no buying decision. The money moves automatically. The contribution happens, and the investor's emotional state on any given Tuesday has zero effect on their long-term portfolio. This is the 3-word fix: automate your contributions. Recency bias is the tendency to overweight recent events when predicting future ones. In investing, it shows up as the belief that whatever has been happening lately is what will continue to happen. That a sector that just had a great year will have another great year. That a market that has been falling will keep falling. That the recent past is the best guide to the immediate future. What it looks like in real investing life: every January, the top-performing ETFs and sectors from the prior year receive massive inflows of new money from investors who just watched those returns and want in. And consistently, the following year's top performers are different categories entirely. The money that poured into last year's winners often arrives just in time for the mean reversion. The investor who sold bonds to buy technology in 2021 because technology had been on a historic run. The investor who sold energy in 2020 because energy had been crushed and clearly would never recover. Both of these investors were using recent history as their primary forecasting tool. And both were wrong in the specific, costly way that recency bias produces. A more personal version: you check your portfolio after a rough month. Everything is down. Your brain immediately generates the feeling that it will keep going down. Not because of any specific new information, but because the recent experience of falling is vivid and the experience of recovery is abstract. This is recency bias generating a feeling that is genuine and real and completely disconnected from historical base rates about how often markets recover after declines. The fix: base rates over recent experience. When recency bias is generating a feeling about the market's direction, the specific counter is to deliberately look up the historical base rate rather than the recent experience. How often has the market been higher one year after a 20% decline? How often has a sector that significantly underperformed over a 3-year period beaten the market over the following 3 years? The base rate answer is almost always more reassuring than the recent experience answer, because the recent experience is a sample of one, and the base rate is a sample of decades. Surveys of investors consistently find that the large majority believe their own investing ability is above average. This is mathematically impossible. The average is the average. But it is also a documented universal feature of human self-assessment called overconfidence bias. What it looks like in real investing life: the investor who buys individual stocks because they have done their research and believe they understand a company better than the market does. The investor who trades frequently because they have a feel for market timing that they have confidence in. The investor who concentrates heavily in a sector because they are deeply familiar with it professionally and believe that gives them an edge. In each case, research consistently shows that the outcomes are worse than a boring, diversified, low-cost index fund held without intervention. Terence Odeon's landmark study of 66,000 household brokerage accounts found that the most active traders, the most confident ones, underperformed the market by the widest margin, specifically because their confidence led them to trade more frequently and incur more costs and timing errors. The fix: treat your own conviction as a warning sign, not a green light. This is genuinely counterintuitive, but the research is consistent enough that a useful heuristic is: the stronger your conviction about a specific market call, the more deliberately you should slow down and ask what you might be missing. Not because you are always wrong, but because overconfident investors are statistically more likely to be wrong in exactly the direction their confidence points. Anchoring is the tendency to fixate on a specific number, usually the price you paid for something, and let that number distort how you evaluate the current situation. What it looks like in real investing life: you bought a stock at $50. It falls to $35. You tell yourself you will sell when it gets back to $50. But the stock at $35 has no knowledge of the price at which you bought it. The stock does not care. The $50 price was relevant to a decision in the past. It is not relevant to the decision you are making today, which is simply, given everything I know right now, is this the best use of this $35? The anchoring error is letting the $50, a number meaningful only to your own psychology, determine your behavior rather than the current facts. An investor who would never buy this stock at $35 but will not sell it because it hasn't gotten back to $50 yet is making a decision based on an arbitrary reference point rather than a current analysis. Why this matters specifically for Canadian investors in a sector-heavy market. Anchoring tends to keep investors in positions that have fundamentally changed. Holding an energy stock that has declined significantly because it will get back to the purchase price eventually, when the business case that justified the original purchase has materially changed. The question is never, when does it get back to what I paid? The question is always, does this belong in my portfolio at today's price and today's facts? The fix. Ask the clean slate question. When evaluating any existing position, ask, if I did not already own this, would I buy it today at today's price? If the honest answer is no, and you're only holding it because of the price you paid, that is the anchoring bias at work, and it is the specific question that cuts through it. Herd mentality is the tendency to follow what others are doing, particularly in uncertain situations, as a shortcut to navigating that uncertainty. In evolutionary terms, this was a reasonable heuristic. If everyone around you is running, something is probably worth running from. In investing, it consistently produces the opposite of good outcomes. What it looks like in real investing life. The stock that is all over Reddit and financial Twitter. The sector that has been on every hot investment list for 3 consecutive months. The IPO that everyone at your office is talking about. The cryptocurrency that your cousin's financial advisor suddenly has opinions about. By the time an investment idea is genuinely mainstream, when it has reached the point that most people in your social circle are aware of it and excited about it, the price has almost certainly already incorporated most of the enthusiasm. The investors who made the spectacular gains were the early ones. The herd that follows is frequently buying at or near the peak of the narrative, right before the price reflects reality, rather than momentum. The Dunning-Kruger layer on top of herd mentality. When an investment is universally exciting, the mainstream coverage of it tends to be the most superficial. Sound bites, highlights, impressive-looking charts from the right starting date. This means investors following the herd are frequently making decisions based on the least informative version of the story, at the worst possible moment in the pricing cycle. The fix: invert the excitement signal. The level of mainstream excitement around an investment idea is, if anything, a mild contrary indicator rather than a confirmation signal. This does not mean automatically avoiding anything popular. It means deliberately increasing the rigor of your analysis in proportion to how excited everyone around you seems to be, because that excitement is already in the price, and the question is whether the underlying reality justifies it. Let's come back to where we started. The average investor consistently underperforms the average fund they invest in. Now you know the 5 reasons why. Loss aversion makes them sell when prices fall, when the rational action is to hold or buy more. Recency bias makes them follow recent trends into positions that are already priced for the excitement that attracted them. Overconfidence makes them trade more frequently than the evidence supports, racking up costs and timing errors. Anchoring keeps them in deteriorating positions because of a purchase price that has no bearing on current reality. And herd mentality brings them to the party after most of the returns have already been made. None of these biases make you a bad person or a dumb investor. They make you a human. The research says everyone has them. The difference between the investor who closes the behavioral return gap and the one who does not is not intelligence. It is structure. Automated contributions that remove the decision from the emotional moment. Historical base rates that counter the vivid recent experience. A clean slate question that cuts through the anchoring. A habit of increasing rigor, rather than enthusiasm, when everyone around you is excited. These are not complicated fixes. They are just specific. And specific is exactly what most investing advice fails to be.